Okay, thanks. So, hello, everybody. Welcome. I want to make sure, let's see. Charles Zimmer says, where do I enter my credentials? Not sure what you're referring to. There is no CE for this event. I apologize for that. And you will see there's a networking section on the left side. I see Mark Mortensen or Mark Montentine. Sorry for butchering your name. Is on there too, giving those instructions. Okay, real quick. If you are seeing this logo right now that says National Tax Reduction Virtual Summit, you are in the right place. If you saw this when you registered, you are in the right spot. This is our agenda for today. Real quick, before we do intros, we are going to do a program introduction, talk about some real life examples, talk about some of the technical aspects of what goes into what we have here. Then I think number 4 and 5 are the meat and potatoes of this event, what you all logged on for. And that is the investment types that you can invest in to create tax advantage situations and tax credits. And we're going to talk a little bit about avoiding recapture. And if we have time, we'll get to number 7 when we talk about selling businesses. Here we go. Program introductions. And there we go. All right, I'm Todd Phillips. I am the one on the left on your screen. I am a tax attorney. I'm also CFO of RE Journals, the company that puts on these events. I was a webinar host during the pandemic. I've done a lot of these things, have a lot of practice, but I still will fumble with the controls, so be prepared for that. My tax company is called Providence Tax and Advisory. We are kind of flipping the whole tax world on its ear. We do tax returns, but a tax return to us is an afterthought. What we do first is planning, and we help you set your tax situation properly to minimize taxes. And after we do that for a year, then it's really easy for us to just file the tax return. That's the completed product of the work that we do. So again, Todd Phillips, tax attorney. Dan, you want to do a quick introduction of yourself and then Eric?
Sounds good. Thank you, Todd. And thank you for helping put this together. So we'll get into a couple examples of really the nucleus and the impetus for this program. I'm an investment registered representative for Irvine Advisors, so about 35 years of investment real estate experience. So that puts me back into 1988. And you can imagine how fun and challenging the market was at that point, but I didn't know any better. So since that time, I, of course, went to law school, studied a ton of tax, enjoyed tax, and then also put together a finance MBA. So about 20 years ago, I started focusing my practice primarily on helping clients with fractionalized interest 1031 exchange, so passive income 1031 exchange investments. And so now I've got hundreds of clients coast to coast, meeting with clients sometimes for the first time at an airport on our way to do either a market tour or a property tour. So Todd, thanks for helping organize this. Eric, thanks for joining, and look forward to helping others with some other pretty complex tax issues.
Appreciate it. Thanks.
Yeah, Eric, go for it.
Yeah, thanks, Dan. Thanks, Todd. My name is Erik Conrad, CEO and founder for InCommercial Property Group. I've been in commercial real estate since 2002. We were brokering transactions initially. We were always a very high-touch, client-focused. Worked with a lot of investors for investment real estate. I've transacted on a few $1 billion in assets, touching many thousands of single-tenant assets. There's always two components I'm sure we'll get into that we focus on, right, with the economics, but you also want to maximize the benefit for investors. So at this point, we sponsor a number of private offerings as well as provide those real estate services, property management, asset management to a wide array of investors and clients. So appreciate being here.
Okay, so we're going to kind of whet your appetite. I hope that's okay with everybody, and just talk about a couple of real life examples. Dan and I have known each other about as long as you've been in the business, Eric, where the three of us are all kind of the same generation. So we've been around for quite a while and been doing these transactions for a while. And like Dan said, tax focus. So my thing and Dan's thing has always been, there's some tax reason that we're enhancing this transaction. There's some reason why we like it, because it's going to save us taxes. So I've got one quick story I'm going to share. A client of mine 3 years ago called with a failed opportunity zone, 2 1031 exchanges that he needed to fulfill. and a huge tax bill for that year. And I just happened to have the perfect solution for him. I said, hey, why don't we go out and buy some gas stations? So we bought just under $20 million worth of single tenant gas stations, long-term lease. But because the way gas stations fit into the tax code, they qualify for bonus depreciation. Some of you may be aware of that, some of you may not. But that bonus depreciation is the biggest paper loss ever created by Congress in the history of tax losses, okay? He was able to write off almost the entire purchase amount of those in the first year. Okay, so if you understand 1031s, he did have a lower basis in some of those properties. But when we completed the transaction, the result for him was it fixed the failed opportunity zone, the income from that. It fixed his current year taxable income. And it also gave him a carryback loss that wiped out his taxable income for the year before from another failed opportunity zone. So he solved all of those problems without coming out of pocket with any cash. Pretty amazing transaction, but that's real. That does happen. It happens every day in this country if you go into it with the purpose of minimizing taxes, and that's your goal. So Dan, you've got one you wanted to share too.
So this interesting example, maybe not as sizable as your particular tax consequence, but working with a client 2 years ago, client, I think it was the first quarter of the year, says, Dan, I'm in the process of writing a $400,000 tax check, state and federal. And he says, Dan, this has got to stop. So we went to work. We looked into a couple different investments. We started out with conservation easements. The first, and now those are really characterized as fee title land programs. And we also looked at defined benefit plans. At the end of the day, just with those two programs alone, we were able to reduce about $265,000 in taxes, keep $300,000 into his retirement account. And at the end of the day, we by adding on a couple other strategies, we were able to have or reduce the total tax bill by $400,000, and then add on another $400,000 to his net worth, or $417,000 to his net worth statement. So in further years after that, we started working a little closer with the CPA, put together other strategies. So not only is the client currently investing a little bit more tax efficient, but also really managing his tax bill. So I think the closest way or quickest way to increase your profit is to reduce the number one expense, which is your tax bill.
Yeah, I know that we didn't talk about this example, but I think I have one, Todd, that probably speaks to this audience pretty well, right? I mean, I'm the owner of my company. I file taxes as a real estate professional. We invest in stuff. We looked at gas stations and motor fuel opportunities. Late last year, I did it with a pool of investors, put in $3 million and wrote off $3 million, 2.9, I think, for last year's tax bill. So, obviously a pretty significant gain, pretty significant, your comment earlier about just the way the IRS treats depreciation in general, right? Depreciation is a paper loss that you get to take. Appreciation is a paper gain that you don't have to recognize. I mean, that fundamental mismatch makes real estate just incredibly powerful. And then, obviously the three of us, with many others, work on how do you really leverage that? How do you maximize that benefit to the investor and really put it front and center? So
perfect. Well, that's the meat and potatoes of what we're going to talk about. That was the preview. So those are our real life examples. Next up, not sure why my screen goes blank. Basis, losses, and incentives. So I'm going to take over here for a minute, Dan and Eric. Feel free to chime in if you want, but if you feel the need, there's some really important nuance to tax law. I don't know if you've ever looked at a book of tax law, but when I first started, I was at the national office of one of the largest firms where we would nationally dictate tax strategy. And so I spent a lot of time reading the tax code and the regs, and the tax code is thousands of pages. It's a thick book, and I liked reading it and having it in my hands. But the regulations are seven of those books. So you think 8 books that contain what's in here. And what Congress does in one place, they like to take away someplace else. They've become famous for it. So they give you this benefit. Everybody gets their student loans repaid. Well, but only if you make less than a certain amount. So there's all of these ifs, ands, or buts that are included in different parts of the law. So there's a lot more to this that we're not going to have time to talk about. But some of the basics that are really important I want to make sure we hit on. So the first is the idea of basis. And I think of basis as a beach ball. And there's basis is, let's just say you bought a property for $1 million. And then there's this concept of depreciable basis. If the land of that property was 200,000, now you've got 800,000 value of the building. So that's a depreciable basis for the building. If you go buy a truck for use in your work, that whole thing is depreciable basis. You buy an $80,000 work truck, depreciable basis is $80,000. Okay. That's the idea of basis, and basis is what you start with for depreciation. So to me as a tax advisor, that's an awesome tool. There's other tools we're going to talk about here, but that tool right there, depreciation is a paper loss. Okay, it may actually depreciate down to zero. That truck may be worth nothing in 5 years, 10 years, whatever the time frame is. Okay, but from an IRS perspective, we want those paper losses, taking that depreciation, and we want to take it as fast as we can. So one of the things I first tell all my clients is if basis is a beach ball, it's my job to deflate that beach ball down to zero. Okay, and as fast as we can possibly do that. So that's the beauty of these, Eric, of your fuel opportunity, and Dan, some of the other things. We want to get rid of that as fast as we can so you get the tax benefit of it as soon as you possibly can. And there's never been a better time in our history with bonus depreciation and some of the other things that are going on to be able to do that. So it's exciting stuff for me as an advisor to be able to deflate that balloon, that no basis balloon. A couple of key concepts here that are way outside the scope of this, but if there's three really types of investment buckets that the IRS makes you categorize your income and losses into, and that's actively participating. It's your business that you run. If you run like RE Journals, we're a media company. That's our active business is media, and we're actively involved in that. So that income and loss goes in one section. And then there are passive losses and portfolio losses. We're only going to talk about just this passive idea in general. So passive losses and active, passive and stuff and active doesn't matter which bucket it goes into until one of those buckets generates a loss. So if we've gone in and generated a big paper loss in your passive bucket, it can't offset anything in the active bucket. Okay, so what a lot of people think they can do, and I see this on like TikTok and Instagram and InstaFace talk, they tell people, hey, you can actively participate in rental real estate. You can't do that. You can't actively participate in any rental business. It's not a thing. I'm here to debunk that. You can't do it. The only way to take those losses against active income is to do what Eric alluded to, and that's be a real estate professional. Okay, so point two here is you actively participate in real estate. That activity may still be a passive rental activity, okay? I know this gets confusing, but then it just frees you up from taking those losses. So now you can ignore the rules that say passive losses can't offset active income because you're a real estate professional. I won't get into that here. I promise you we'll have another webinar or 2 or 3 on how to qualify as a real estate professional if you're not a real estate professional, okay? The number one way to do this, so if you, from the list of stuff we're going to show you, if you say, hey, I want to do a deal that's real estate and is going to create passive losses, the best way to get into that, the keys to that kingdom, is to have your spouse qualify as a real estate professional. Only one of the two of you has to qualify. Okay, so that's a pretty neat little trick you can do if you say, I work in an active business. I want to offset that income and I want to offset it with passive activity. There's the trick there that you can kind of do.
So Todd,
right.
quick note there. Some
Yep.
of us have heard the term real estate professional, so there are some qualifications. So if you have a question on that, either put it in the chat or just send us a note or an email.
I do see
We'll
in the chat
make sure
too,
you have our contact information.
yeah, somebody asked about cost segregation for real estate. I think that's a great point. So when I went back to the, how fast can we get this beach ball down to a deflated beach ball, cost segregation studies, and I think there's a couple of people registered for this event that are in that business. That's a great way to accelerate depreciation. And that requires somebody that's an engineer, or somebody that's trained that can write an appraisal report that says some of the elements of what you think are longer term depreciation are actually shorter term under the code. but somebody has to make that determination for you. That's a professional. The IRS has gotten really good at dissecting those. 20 years ago when it was new, it was a little more loosey-goosey, but I remember when they first came out and it wasn't clear. Today it's crystal clear. So hire a professional to do that, but that's one of the ways where you can do that. I've heard cost segs.
And that's the function that, and that's the function that'll enable you to maintain more after-tax income with the shielding income from tax.
Right.
So Todd, you had alluded to this earlier though, about the unique nature of certain asset classes. And I don't want to jump ahead for the presentation, right? But I think the relatively brief answer to that person's question was, in this case, we do not need cost segregation because of how it fits in.
Yeah, right. And somebody else asked, I heard cost seg's not effective in Minnesota. How true is that? Everything has to be taken together as a whole. There are lots of states that have add backs, but don't let the tail wag the dog necessarily. Just because a small portion of it isn't quite as effective doesn't mean it's a bad strategy. One of the things Dan and I do, we come in and we figure out what's your tax liability over time or the next few years. How do we minimize that? Cost segregation has to be a part of that if you're looking for passive losses. But Eric, you brought up a good point on some of these assets, and we're going to talk about that. Here's our list. Here's what you've all been waiting for. Is some examples, and we'll just kind of talk through a little bit about each one of things that we see that will work. This is not an exclusive or exhaustive list of everything that's out there, but here are some of the ideas that are floating around right now that can help you get there. So Eric, you brought up a good one. Do you want to just talk about fuel stations and how bonus works and how much you can write off?
Yeah, I mean, I think, in the, we wrote a little white paper, which is still kind of going through compliance. And they took out things like my comments that the IRS in its infinite wisdom has determined these schedules for us, but that is how I feel about it. Commercial property, your depreciable basis that you're talking about, it's a 39-year schedule, right? So you depreciate 1/39th. On apartment buildings, it's 27 and a half years, right? So it's 1/27th and a half. How somebody came up with the half, I'm not sure. Gas stations, car washes, a lot of the other things on here, land improvements. The IRS has determined those are 15-year assets. How they came up with them and the rationale behind them, we can speculate on. Doesn't really matter. It's 15 years. And all of what we're doing, right, is in this bonus depreciation, right, is how do we combine these strategies for maximum impact? And a 15-year asset is already going to be defined under the Tax Cut and Jobs Act as bonusable. And you're going to take all the depreciation, you're going to take 80% this year of the depreciation basis without having to do any real further analysis, as long as you qualify as one of those assets. So it's, simplifies it quite a bit. The comment on the, Minnesota, I know we get those questions a lot because we work in a lot of different states, and, you got federal taxes and you've got state taxes and they don't always match, but I don't think there's any state. I mean, I haven't watched what's going on in California that closely, but I don't think there's any state that taxes at the same rate as the federal government. So you still get a pretty big benefit. So
No.
I muted myself. When California gets a 39% tax rate, 39.6 or whatever they're proposing for federal right now, that's going to be tough to live there. It's almost 100% total. Yeah, that's a good point, Eric. Federal is sort of our starting point.
Later in the presentation, we'll touch on 1031 exchanges, but in some cases, we've worked with clients that have decided to invest in a fuel fund type, so fuel stations, as either an alternative to a 1031 exchange or a failed 1031 exchange, or other ways to really maximize the efficiency of minimizing a tax.
Yeah, I think that's a great point, Dan. And the client I brought up earlier, that was the case where they had a failed exchange, failed opportunity zone, some tax dues that they weren't anticipating, and were able to use something that was really high depreciation, a fuel station, and just write off enough to cover the gains on those. So we were able to make that work. And I think you have a couple clients you're looking at that for now. Okay, so that's kind of fuel stations. Car washes are very similar. What Congress did when they enacted bonus depreciation. So if you're new to that term, bonus depreciation means you can depreciate 100% of it on day one. It's phasing out slowly now. Today it's at 80%. But every asset class that Congress in its infinite wisdom, as Erik so wisely put, decided was less than 20 years. So if you look at the schedule in the tax code, things that are under 20 years, those are the things bonus depreciation. For the most part, there's caveats to everything, like I said, but those are the things you're kind of looking for. So that's why land improvements, some other things like that do qualify. So if you buy a building and you have to put septic and sewer and stuff in it, that's going to be the kind of stuff that qualifies for bonus depreciation. Okay, I'm going to go on. This was my thing here, hog barns and farm buildings. I've been contacted by a lot of people now in my home state of Minnesota, in southern Minnesota and Iowa. There are a lot of these. They're depreciable over 5 years, and right now they'd be eligible for bonus depreciation. So that right now is an asset class that a lot of people are looking at that they never even considered before. It also applies to oil production and storage. Those things have shorter lives as well. So what's not on this list is apartment buildings, office buildings, industrial buildings, unless you do that cost segregation study that was alluded to in the chat. Do any of you have anything to add on those other two, hog barns, farm buildings, oil production? I know, Dan, we're going to get to oil, but you want to add something on that?
No, just energy in general has, like you mentioned, similar to depreciation, it's depletion. And there are a couple different types of depletion. So that helps energy investments become tax efficient. Next to that, over to the right, you'll see working interest, which is another form of energy. So that helps minimize your income tax in the current year. And now you also have an investment that's going to be increasing and generating income. So that's an interesting one as well. But those are the two that have depletion and other tax efficient strategies.
Now, you've had clients, Dan, in the past that have been able to minimize taxes through, on somebody just commented, conservation easements. Awesome, we're getting to that. The oil and gas, where they're wiping out most of the income, at least from that oil and gas. Have you seen any kind of energy products where they're creating excess paper losses?
Well, it's generally limited to the amount of fixtures that you put into the investment. So that's the intangible drilling costs, and there's a schedule for those.
Yep.
It's generally anywhere between 85% the first year and could be a little bit higher. Different programs vary. So I've seen up to 85% the first year, maybe a tad more.
And I've seen excess write-offs created when you get into the refinery side of the business. Okay.
We had an interesting question. I always love to pick your guys' brain. So we had an interesting question that came up this morning when we were talking about, retail motor fuel outlets. And somebody said, well, I have a Tesla and it's a motor and I need fuel for it and I plug it in. And so there's a whole different thing about the tax code, but then we were looking up the depreciation schedule on those actually, it's equipment, right? So the majority of those Tesla service stations they have, I'm just wondering if anybody's kind of explored those. But it's predominantly equipment. It's land plus all. I don't know. Can you attribute most of the value if someone buys a electric vehicle charging station and use a similar strategy? We need to expand your list a little bit. So
yeah, we didn't go into the solar. Somebody asked about solar here and some of the other and the charging stations. Anything that's under 20 years is going to qualify for bonus depreciation. But when you get into solar and energy production, there's a lot of new tax credits that are out there. I'm happy to do a webinar on that, but that's a 1 hour conversation, or at least a half hour when we get into those things too. So don't forget about those. Solar, energy, any kind of energy thing like that are important to that. So yes, solar farms, anything that's in that farm that's under 20-year life spans can qualify for bonus. And again, right now, bonus is 80%. Equipment, anybody want to talk about equipment? Sure, we have some business owners here, probably been using Section 179 and writing off equipment for years, which is for the most part superior to bonus depreciation, but happy to have a conversation offline if you want to talk about equipment programs. One thing the IRS did take away, a friend of mine used to run the 1031 exchange arm of a equipment rental company, and that's been taken away by Congress and I think it was the 2017 Act. So to be able to exchange equipment for new equipment and not recognize the tax, that's gone. So bonus depreciation has played a big role for those people because they just write off the full price of the new one. They don't have to do a 1031 exchange anymore. So like Dan said, sometimes the alternative to a 1031 exchange is just something you can write the whole thing off on. Furniture and fixtures, same thing. So again, we didn't list on here apartment buildings, office buildings, things like that. But to the extent that those things you buy have furnitures and fixtures in them that somebody qualified to do a cost segregation study can do for you, then you can write off some of those items and create paper losses that way. All right, Dan, we're going to turn it over to you for working interest energy IDCs.
It briefly touched on that earlier, and should have probably also introduced the fact that my goal here is not to provide tax or legal advice. So always consult your advisors, your tax professionals, your legal professionals, and then reach out, make sure any investments that you consider do match your current portfolio and long and short-term investment goals. Working interest, again, it's generally a method to take advantage of the, I would say, energy policy that's changed dramatically in our country, but also make a forward investment, write down your current income tax, but also have an investment that will continue to produce income for you. And it is generally tax advantaged as well. If it's out of Texas, of course, no state income tax.
Correct. Nice. Somebody asked about repeating about hog barns and farm buildings. I'll do that at the end if we have time. Happy to do that. But let's move on to conservation easements. Dan, you've done a few of these, right?
So conservation easements, and again, as Todd mentioned earlier, the government might give it a benefit in one area and take it away in another. So conservation easements are now transitioning to what are called fee simple land programs. And at the end of the day, you are now donating the value and the benefit of the land. So what you could do, and programs that I've seen from some of the larger companies in the country, is you write down up to about 30% of your adjusted gross income. So, and then you take your, and this is fee simple land programs, you take 5 times the value of your investment up to 30% of your adjusted gross income. So it's fairly complex, as you can see. So there's an extensive learning curve, but it can be effective. So just about everything you've seen on this slide and others, it's really part of a comprehensive strategy. Happy to go into more detail, but it has evolved since last year's midnight hour tax program that was ushered through.
Yeah. So that's a great point about the. I'm not here to. I'm glad you brought up. I'm not here to give legal advice. So there's a couple people posting things in the chat room. I'm happy to do that offline. We'll include our contact info here at the end. You'll get an email with that. And then also, if you want these slides, I'm going to put a link in the chat room to download the slides, which also, when you get those, it'll have my contact info in there. Happy to talk about some of these very specific scenarios in an environment where I can actually provide you legal advice. I just can't do that over this platform, and I'm not going to open myself up to that either. So yes, this is not legal or tax advice. We're just talking generally about some of the rules and how they may or may not apply to you. Okay, so that's conservation easements. I too have seen those. They are limited to a portion of your AGI. So Dan and I like to look at the world and say, how can we wipe out somebody's complete tax liability? Sometimes it's impossible, and sometimes it really works. But conservation easements are just, you can only write off a portion, and the smaller your AGI gets, the smaller that portion gets. So some people find them incredibly attractive because you don't have to be a real estate professional to do it. Others say, well, I'm gonna use depreciation to negate my tax exposure, so a conservation easement doesn't necessarily work. So there's always ifs, ands, or buts. But there is an opportunity in conservation easements, even if you already own a property, to grant a conservation easement on part of the property and get a tax deduction for that value. So even if you've built an apartment building on half of it and the rest of it you want to dedicate as a park or park property, there's a potential there to get a tax advantage strategy there. Okay, opportunity zones.
In that case, sorry, I think in that case, then it's up to 50%. It's the other structures that have been modified down to 30%. So yes, there are more ways to do that.
Right. So Dan, what you can help an investor do is find one of those property that's been syndicated. So you can invest a smaller amount in a bigger property and receive the benefits of the whatever you're calling it now, fee simple. Is that correct?
Yeah, fee simple land program.
So most of the stuff we're talking about today, you can do on a very small scale up to a very large scale. So if you're a big enough investor that you can do all of these things on your own, that's just fine. If you want to buy a portfolio of fuel stations on your own, you can do that. If you want to just invest $100,000, those investments are out there, and Dan and Erik both have those where they can help you find the right fit for you and put your money into those transactions. Same is true of conservation easements and a lot of these other things that we're talking about. Glad we made that caveat. So moving down though, opportunity zones been there's been a lot of webinars on that, and there's a lot of information out there on opportunity zones, but don't forget about them, right? Dan, do you have any advice on op zones, things that you've seen?
So in some cases, it's an alternative to a 1031. If you have a higher basis, you can keep that. So it might be beneficial in some situations not to do a 1031 and do an opportunity zone. You keep the basis, invest the gain. And there are some opportunity zones that have income right away versus a development type opportunity zone. So those can be interesting. And then also, of course, if you have a situation where you have a failed 1031 exchange, or you sold a business or other appreciated asset, an opportunity zone, if you're not looking at the fuel station concept, an opportunity zone would fill in there as well.
Yeah. Okay, moving on down, and this is one of my favorites, and one that I caution a lot of people on, and that's life insurance. If you're like me, I get a little cringy when somebody wants to sell me a whole life policy that has a lot of bells and whistles to it, and it looks more like an annuity or something that's really not a straightforward life product. I think those are good. They have value, no question about it. But what I'm talking about, and we'll get to another slide that this applies to, life insurance, if you just have a term policy, guess what? That's tax-free. So if you're doing something over here that is messing up your estate and creating tax obligations for your kids or whatever's going on here, you can always go over on the other side and buy yourself a term policy that's going to replace that. So it's a pretty neat strategy for passing money on to your heirs without having tax consequences. So if you've created all this depreciation problem for your kids, you can kind of solve it by doing some other things that aren't going to cost you dollar for dollar as much. Okay, Dan, and back to you for retirement plans. And we're talking about, this is just taking actual cash from your business, putting it into a retirement plan. Especially self-employed people have some pretty amazing options that I don't think everybody knows about.
Right. So entrepreneurs, self-employed, especially real estate professionals, opportunity to increase the amount that you can write your income down, but also increase the amount that can go into a retirement plan. And a retirement plan, it's a self-directed, self-defined benefit plan are the buzzwords here. But long story short, generally most individuals think of a SEP in the $57,000 range. That's not a whole lot. Now, the beautiful thing about retirement plans, now you have a protected asset as well. So there are other smaller strategies, but this one can really add to your asset base, allow you to decrease your income. So depending on if you want to set that program at, say, $300,000 a year, well, now you just saved $100,000 in income tax. So everybody's income tax is different, but this is a way to really increase more protected assets for your balance sheet.
I muted myself so I could I put in the chat room the link to the slides. So if you're if you want to open up that chat on the Zoom chat, there's the link there. And that would just ask you to answer a couple questions about yourself so we know who you are, and then you can download the slides, and that'll help us kind of create a relationship with you going forward if that's so desired. So back to retirement plans. There are types of defined benefit plans, Dan, that you've seen people put enormous amounts that seem like on paper, well, that you shouldn't be able to do this. Can you just share some of, what's some of the bigger numbers you've seen?
Well, of course, the lower number is 200,000, but 500,000, a million. So it's really relative to whatever your overall annual income is. So again, a couple different ways to take some money off of your annual income, put more protected assets away for you and or your family. So it's just really relative to an individual's income. And there's an administrative component to it, but there's also an approach that you can actually direct where the assets go to. So of course, we don't necessarily always want those to go into the equity markets. I think what we've seen over the last 3 to 5 years, maybe last 3 hours, would tell us that you want to be sensitive to where you're putting your assets.
Right. I apologize. I just saw somebody said, is this going to be recorded? Yes, this will be on YouTube. Usually takes my team 24 hours to turn it around, but you know, you can look tomorrow morning. I'm going to put that link in the chat room too in a minute here when I can stop talking long enough to copy and paste. So retirement plans are fantastic. I call them, to me, there's a world, I call it tier 1 tax strategies, tier 2 tax strategies, tier 3 tax strategies. Tier 1 tax strategies are things that you already do. You already, like, one of them might be employing your kids in your business. You're already giving your kids money. You might as well run it through and call it employment and make them go do something, clean your apartment buildings, right? For, you know, kids should learn how to work, right? So that's something you already do. And you characterize it the right way on your tax return, you get a deduction for it. Tier 1, super easy because the money's already spent. Tier 2 is I got to take my money and do something with it. And I may not be able to touch it, but that's still a really good tax strategy because I'm going to get that money back down the road, right, Dan? So retirement plans, I'm setting aside money for my future now, getting a huge tax benefit for that. So that's a tier 2, but it's clearly one of the favorites. I'm going to go back to screen share here. Thank you for your patience. Okay, tax credits we didn't talk a lot about. Dan, do you have anything on tax credits you want to talk about? Otherwise, we probably at 1:37 in the afternoon here have to push this to another webinar.
Yeah, initially we talked about setting aside 45 minutes. We can grow that depending on Q&A.
Sure.
So, but yes, tax credits I think are just an opportunity to also make similar investments where you can write down your income, find a tax efficient investment, not as widely used by individuals, but it's something that can be, depending on how you're organized as an LLC, S Corp, or what, that may be of interest.
You know, looking at who's registered for this event, it's a very entrepreneurial group and a lot of real estate people because obviously RE Journals is the sponsor of this event. But real estate people might want to look at tax credits if you haven't already or haven't lately as a tool for you to grow your business too. So low income housing tax credits, historic tax credits. There's a lot of things that we can counsel you on and help you with that are related to that you can sell the tax credits to somebody else. And the reason this exists is that you said, Dan, you don't see a lot of individuals use tax credits because Congress shall giveth and Congress shall taketh away. And they've taken away the ability for most individuals to use most of the types of tax credits that are out there, but they haven't taken it away from large corporations. Although they did institute a corporate minimum tax scheme, large corporations still are out there buying, C corporations are buying tax credits because that's a tier 3 strategy. It's better than the money going to the IRS, right? So a historic tax credit, I've done one of those deals. The investors in historic tax credits maybe give you anywhere from 92 to 98 cents on the dollar. And then they get a little small piece of a trailing return. So somebody that works in the Treasury Department of a large corporation, and rather than cutting a check to the IRS for $10 million, they maybe write that check for $10 million to historic tax credits, and they maybe get, you know, a few $100,000 or a few tens of thousands as a return on their investment. So it's not a, you know, not a huge home run, but it's better than giving it to the IRS. So that's tier 3 for me. Thank you for indulging me on my awkward things. Okay, avoiding recapture. So anybody has any questions, put them in the chat room or put them in the questions. And I'm happy to go back in and we can talk about some of those things to the extent we have time when we're done. But I want to talk technically about this piece, and I think Eric and Dan, you can chime in here too. So all of these things we've talked about, so not all of them, some of the tax benefits you're going to get are permanent and there's no recapture. There's no rebound. There's nobody ever asking for that money back. But in the case of the big one, depreciation, bonus depreciation, there is this idea of recapture. So someday if you bought that gas station, depreciated all of it or all of the building value, kept the land value, and then you went and sold it, you're going to have, and you sold it at a gain or sold it for what you bought it for, even a little bit lower than what you paid for it, you might have to recapture all that depreciation. Okay. So I'd like to tell people it's okay if you have to recapture. No one wants to write a check back to the IRS. Then in that case, if that's your strategy is just to pay it back, it's still an interest-free loan from the government. And you, in some cases, you can pay it back at less than 100 cents on the dollar because of the tax rates. You know, how you write it off against certain types of income, it gives you that, and you pay it back at a lower, potentially lower rate of either capital gains or recapture tax. Okay, so at the very least, it's a long-term interest-free loan that you don't have to pay back quite 100 cents on the dollar. That's a home run in and of itself. But what we really want to do is not ever have to pay that back. So this is where a lot of the other tax strategies come in. So I like, when I'm talking with clients, I like to show this picture. If you remember Indiana Jones, all of us are at that era, right? Where he's running away from the giant boulder because he stole the golden thing. So this is all of us who have taken depreciation over our lifetimes and are holding properties or equipment or whatever we have that has a lot of that we've taken paper losses for it, but it still has value to it. So we want to run from the bad man for as long as we possibly can. So what are the strategies to, you know, zap that giant boulder or get away from the giant boulder or find that exit door on the side that's going to let you escape from having to do that? The first one is one of my clients likes to say, just die with it. You know, when you die with it, your heirs get a step up in basis and now they can sell it without having to recapture that loss. So death is the ultimate tax plan for some people. If you talk to them, you know, I don't like to plan for, you know, I'm saying our exit strategy is death. That's kind of morbid, but when we do estate planning, that's certainly a piece of it. And we brought this other one up, life insurance. That's certainly a possibility. If you've got a large, you know, thing that's going to happen at death and you didn't get the step up in basis because you did some other estate planning with gifts or a family limited partnership or a self-canceling note or something like that, you can use life insurance to give your heirs the money to either pay that tax or replace the money that you weren't able to give them because they had to pay that tax. So that's a strategy for, but you have to, again, you have to die to do that one. The bottom one here, and then the one on the next slide are the two that I really want to focus on. Number 3, the bottom one, this is where Dan and I, our heads are at right now, and Erik's for sure. All 3 of us 100% are saying, look, if you've got something that triggered a bad tax consequence somewhere, you have to exercise stock options. You're selling a property and you don't want to do a 1031 exchange, or your 1031 exchange blew up because the deal fell apart, or your opportunity zone fell apart because you put the money in a fund and then you could never buy what you wanted to buy or do what you thought you could do. Just create more depreciation, right? More paper losses. Go back to that list of investments. Call Dan, call Erik. Figure out a way to offset that, recapture that gain by having losses somewhere else. So again, passive can offset passive. So if you have passive gains from the sale of one property and you have passive losses from buying a fuel entity, you can now offset those against each other. So that's always a good strategy to not forget about. Last one, Dan, this is kind of your bailiwick, right? Is our 1031 exchange. So just about everybody on this call looks like they're probably familiar with 1031 exchanges. But I'm going to turn it over to you for a little bit, Dan. Talk about the 1031 exchange universe, how some of these things may fit together, and creating depreciation.
Thank you, Todd. And also Erik is very astute in this area as well, which I'm sure most of the audience is. My primary focus would be helping my clients that have sold real estate, have the depreciation, like you mentioned, so lower basis, want to avoid depreciation recapture. So their focus is to complete a 1031 exchange. Now, many clients that I'm working with at this point, given all of our age range, they're looking to go passive. They'd like to move on with their life, go ahead and either play some more golf, travel, see their family. So 1031 exchanges in a passive income Delaware statutory trust structure has been the favorite structure over the last 10 years or so. Previously, it was the tenant in common, but that doesn't provide as much efficiency for the management of the asset. So very rigid in challenging market times. So working with clients looking for passive income, have an assortment of properties that we show, go through the due diligence, and or even tours. So we've got some property tours coming up last week of this month and into next month.
So when you talk about Delaware statutory trust, that works really well for somebody who's got a smaller dollar amount. maybe wants to buy a higher quality property or needs to match an exact dollar amount kind of thing. Those are far superior products, right, Dan?
Yeah, and I think it's relative. So in the late, in the 90s, in early 2000s, you saw investments in the $400,000 to $500,000 range, and I would say the average client now has $1 million to $3 million that they're investing with. But we learned over the last 3 to 5 years that it was harder to find properties for $1 million, $1.5 million, and have selection and not feel like you're competing and driving down the cap rate. So I would say the average investment is anywhere between $1 million, $1.5 million up to $2.5 million, and then clients, of course, in the $10 to $20 million range. But so it's all relative. But yeah, it's relative because $1.5 million we found over the last 3 to 5 years is tough to compete and find good properties. So the passive income Delaware statutory trust, and my firm works with Erik's firm that has all the management in place, and then you can literally go down like a menu, choose what you're looking for, and then we can start sharing the due diligence.
Yeah, I would draft off of that a little bit and say, I think in terms of the people who do it and why we work in that space so much, is really that it becomes applicable and just much easier for someone to go to you, Dan, and they're in the middle of a 1031 exchange. The tax code is complicated. I know there's a lot of great questions on here that probably none of us will answer because we've all deferred to. I don't know your facts and circumstances, so I can't give you advice. But the to come into your office, look at our offerings, look at 10 other people's offerings, have everything laid out in one, make a decision that afternoon, be done and settled, have professional management, have the spread out of the risk, have, pick up bases, do a lot of these other strategies, have it packaged for you without having to incur, significant, not only brain damage, but, pursuit costs and capital and time. And it's really just, I think for a lot of ways and as the industry has evolved, it's just a great product. So.
Yeah. And one of the other ancillary benefits, many of the different investments that you look at will help you match debt if you had debt on the sale of your property. So now it would go into a non-recourse debt. So now you're not qualifying, signing on the deadline. It wouldn't be attached to your other assets or credit. So that's part of the efficiencies. If you're selling a property that had debt, now you can match that debt, which is a part of the 1031 exchange rules. If you're not bringing in additional capital, which many clients would rather hang on to that capital instead. So it does have non-recourse debt in place for you.
Yeah, going back to Erik's comment about people's specific situations, there are a couple questions on here that are good questions. One of them talks about combining tax strategies. Absolutely, we do that all the time. That's the home run here when you really can hit it out of the park, is when you can take 2, 3, 4, 5 things. You have to make sure that they work together and that they don't fight with each other. And again, that's probably on a case-by-case basis. I did go into the chat, which is different than the Q&A. If you open the chat, I did put all of our email addresses in there, as well as we'll send out an email to you after this event with links to the slides and links to the YouTube channel and our email addresses. So good questions, yeah. One person says, what are other tax credits commonly used other than low income and historic? Again, so there's a myriad of tax credits for low income people. The cool thing is you could be wealthy, and if we can drive your tax down enough, you can actually be eligible for some of those tax credits. But without getting into those, the ones corporations or investors use, R&D tax credits really big, and then all of the new energy tax credits. And the one, I think, didn't Biden pass a big deal for building semiconductors? So the last couple pieces of legislation have had a lot of tax credits that aren't necessarily in the scope of this event. But again, happy to, if you want to engage in a conversation about how that works for you and some ideas that might work for you, we're all here for that. Okay.
I'm gonna, just make a little plug for you there, Todd, because I've done some of that myself where, 1 year you get the tax credits. So you can also, right, I mean, there's a lot of strategies where income, which year is it going to be in? How do you allocate it? What investments do you make? You can create a timing mismatch that allows you to qualify for some of those tax credits as well that are free. and they're kind of nice when you get them. So there's a lot of fun stuff, all heavily facts and circumstances dependent, but
Yeah,
So, and then,
go ahead.
go
Dan.
ahead. We had, we had one other question that may be asking about, do you need to place your funds with a recorder? So for a 1031 exchange, and if that was the case, it's the accurate title is a qualified intermediary. And yes, you would want to have that set up in advance. So we have recommendations and referrals to companies that do a great job in that area.
Yeah, for the uninitiated, a 1031 exchange is a little bit of a bizarre thing. And we throw these numbers around 1020 to, 1031, 444. There's just all these tax code numbers that to me are normal conversation pieces. If they're not to you, I apologize. But when you exchange one property for another, back in the old days, you actually had to, if you wanted to exchange your farm for an office building, you had to find somebody with an office building that wanted your farm. And that was difficult, possible. And then they said, well, now you could do a three-way exchange because the guy with the office building doesn't want my farm. He wants an industrial building. Well, there's a guy with an industrial building that wants a farm. So I want to work at three-way. It just got ridiculous. So Congress, in its infinite wisdom, said you can do a delayed exchange if you put your money with a qualified intermediary. Those regulations are thick, right? Eric and Dan, you guys have done a lot of these transactions. That's a dot your I's, cross your T's type of thing. Don't go into one without an advisor. And frankly, if you're thinking of one, talk to your advisor 1 or 2 years in advance, because there are some things, if you wait, it just had this happen this weekend. Somebody called, they said, I'm doing a 1031 exchange. I close in like 3 days and on my replacement property, I want to close in 2 weeks. And I'm going to do this, this, and this. Oh, okay. Well, we could have talked about this 2 years ago and accomplished some of these things. But the fact that you're calling me 3 days before you close, I can't help you. So to anybody in here who needs to hear that message, talk to your advisors far in advance before implementing any of these strategies. That doesn't mean we can't do stuff at the last minute. I'm here for you. I'm happy to help. You can call me on April 14th. We'll work something out if we can, but it's way better done. And that's why I named my company Providence. Planning, and we can take care of you if you plan for the future. That's how that works. Any final thoughts from either of you, Dan or Eric, or anything that we missed that we for sure, we didn't cover this and we probably should have?
Well, I mean, you are right. There's a lot here, and I think we could probably go deep into the weeds on pretty much everything you said. I would go back to kind of your slide on the different tax strategies and suggest that if anybody wants to use that information, right, you're going to need to talk to probably you or Dan about how to use them, because you made a comment earlier. There's 3 buckets of income, which means there's 3 sort of buckets of losses too that you have to, and you got to match them, right? And so one strategy doesn't work for everyone. I think people get the takeaway of, I'm going to create all these losses and it's going to work for me, and then they have adverse consequences if they try and do them without competent advice and counsel. So, the tax code is long and it's thick and there's lots of details, and it's complicated. There's not much else you can do about it. It's complicated. We put a lot of time into making them fit and create the tools. So,
but I think the message is these should spark some ideas for you. If you read this and you said, well, somebody said, talk more about hog barns and farm buildings. I really think that's an interesting asset class to invest in. Well, hog barns and farm buildings have very short depreciation terms. Even without bonus depreciation, they're very favorable from a tax perspective to buy. It's hard to do it in bulk. I did one large farming company, a meat production company that had a lot of them, and it was a big number. But most people have, the investments are $500,000 to $1 million, but that's still substantial tax write-off. So if that caught your fancy, that should be a trigger to talk to a professional and figure out how to dot those I's, cross those T's. I appreciate you bringing that up, Eric. One person had a question here, and we get this one all the time, Dan. It says, I might have some 1099 income, and I feel like I had a slide for that. Keys to the kingdom. I didn't fill out my keys to the kingdom slide as much as I should have. In order to get the keys to the kingdom, you don't want to be a W-2 employee. The W-2 employees are right now, and I don't mean to get overly political, but that's who's carrying the tax burden for this country. And I have W-2 income, and I despise it. From a tax perspective, but that's how you run the household, and that's how you, that's how you get loans for your your house and your car and things like that, as having W-2 income is not necessarily a bad thing. There's trade-offs with everything, but to this person who has some 1099 and some W-2, the benefits are going to be on that 1099 stuff. So how do I, it may not be some of these strategies that are passive, unless there's rules where it looks like you might be going into a real estate field, where in order to be a real estate professional, you have to be a 5% owner. I don't know that that's going to work in your case, but at least you can get tax strategies that'll cover that 1099 income. And some of those things may cover other income too. So you're actively participating in that 1099. So that's things we didn't cover here, like home office and writing off your cell phone, creating a retirement plan for your 1099, the company that takes that money in. You create your own Schedule C entity, stuff like that. So there are things out there you can do, but the keys to the kingdom are get off the W-2 and get on the 1099. If you don't have some kind of a side business or something going on right now, or even a full business, or you're able to switch from a W-2 to a 1099, that's going to open the keys to the kingdom for you. Dan, do you have any thoughts on that?
Yeah, so thank you. So good idea. Definitely do some research on the internet. You'll find plenty of YouTube videos on how to do what Todd just suggested, but create basically like a side business that will help you bring more of your W-2 expenses onto a return that can minimize some of those taxes that come up. But anyway, you've heard three great speakers, but two in particular, Todd and Erik. But I wanted to mention, you could tell the enthusiasm that's on this panel. And I know it may be odd to have enthusiasm and energy when discussing tax. Todd and I both spend a lot of time around the tax code, and it is interesting and it can be fun when you're helping your clients really minimize their tax burden, whether it's income tax efficiency on their investments. But the reality is you can generally save thousands to hundreds of thousands and more by just doing some very appropriate planning with professionals to really help you get there. Erik's done a great job in helping some of my clients minimize their income and investment tax. So just want to say thank you for the time that everybody put into today. If you do have questions, Todd put our information out on the chat section, but I believe he's also going to be sending it out individually. Thank you everyone for your time.
Thanks, guys.
I missed one thing, Dan, for a plug for you. Conservation easements is a deduction you can take if you just have W-2 income. I should make that clear. The conservation easement, the fee simple thing that you're talking about. There are a handful of things out there that work. Okay, you're right. We are up against time. So to recap, the tax strategy world is out there. We've given you, I think we listed 12 different potential options out there. That is not the entire universe, but hopefully it sparks some thoughts and ideas for you that you can explore further with your advisors. We're happy to be your advisors. Obviously, that's why we do these things. But it's not exclusive either. We're happy to share information with your advisors if that's the case that we need to go through. So again, thank you. Reach out to us with any further questions and watch your email for future events. We want to dig into some of these other topics too. It's always going to be tax related, but there's a lot more on the plate than just what we talked about. Thanks, everybody. Have a wonderful afternoon. I'd like to Zoom way, something I adopted during the pandemic. Goodbye.